When BNPL services first launched, many promoted the fact that they didn't perform credit checks or report to credit bureaus, making them appear even more consumer-friendly. But here's what they don't advertise. Missed payments on BNPL loans can lead to collections actions, which absolutely can impact your credit score. Imagine being sent to collections over a $50 purchase you split into 4 payments. It sounds extreme, but it happens regularly. And once an account goes to collections, that negative mark can stay on your credit report for up to 7 years, all from a shopping spree you thought you were handling responsibly. The data shows these aren't isolated incidents. The CFPB's research found that BNPL borrowers are more likely to hold multiple simultaneous loans, with 63% of borrowers taking out multiple loans at some point during the year. When you're juggling multiple payment plans across different BNPL providers, each with their own payment schedules and late fee structures, it's incredibly easy to miss a payment and get hit with fees. The financial strain extends beyond just the direct late fees. Studies have found that BNPL users incurred 4% more overdraft charges and faced 1.1% higher credit card interest rates compared to people who don't use these services. These are hidden costs that never show up in the BNPL marketing materials, but represent real money coming out of consumers' pockets. The average BNPL loan size hovers around $135, which might not seem like much. But when the average late fee charged by these providers is approximately $7, we're talking about a penalty that represents more than 5% of the purchase price. And that's just for a single missed payment. Miss multiple payments across multiple loans, and you're looking at serious money. It's not surprising that consumer complaints to the Consumer Financial Protection Bureau and Better Business Bureau have surged in recent years. Many users express frustration over unexpected charges and the difficulties they face when trying to get refunds. The problem is so widespread that regulators are starting to take notice and investigate these practices. What makes this situation particularly troubling is the disconnect between how BNPL services market themselves and how they actually operate. They position themselves as consumer-friendly alternatives to credit cards, emphasizing the absence of interest and the simplicity of 4 easy payments. But in reality, they've simply replaced interest with late fees and penalties that can be just as costly, or even more so than credit card interest would have been. So how does a 0% interest payment option lead to serious financial trouble? It's a perfect storm. The combination of easy approval, minimal upfront disclosure of fees, multiple payment deadlines to track, and steep penalties for missing those deadlines. Add in the fact that many consumers use multiple BNPL services simultaneously, and you have a recipe for financial confusion and unexpected costs. The most insidious part is how these services create a false sense of affordability. When something is marketed as interest-free, consumers naturally assume it's the less expensive option. But when you factor in the potential for late fees, collection actions, credit score damage, and the increased likelihood of overdraft fees, the true cost can far exceed what you'd pay using traditional payment methods. For anyone using BNPL services, understanding the full fee structure is absolutely essential. Before clicking that tempting checkout button, take the extra minute to read the fine print. Set up automatic payments if possible to avoid missing deadlines. And most importantly, keep track of how many BNPL obligations you have at any given time, because the companies certainly aren't doing it for you. The credit score paradox. Why BNPL can hurt your financial future. Those hidden fees aren't the only thing BNPL companies keep quiet about. What if I told you these services operate in a credit score twilight zone, where your on-time payments earn you absolutely 0 credit, but your mistakes can haunt your financial record for up to 7 years? The imbalance is staggering, and it's about to get even more complicated. When you see that tempting Pay in 4 button, it often comes with reassuring messages like, no impact on your credit score, or just a soft credit check. This marketing is incredibly effective at making BNPL seem like a consequence-free option. After all, who wouldn't want to spread out payments without affecting their credit? Here's where it gets tricky. While it's technically true that the initial approval process typically won't affect your credit score, What happens after you click that button is an entirely different story. The credit impact of BNPL isn't about getting approved, it's about what happens when payments go sideways. Currently, most BNPL providers don't report your on-time payments to credit bureaus. That means all those payments you diligently make, they're essentially invisible to the credit system. Unlike credit cards or traditional loans where consistent payments help build your credit history, BNPL gives you zero credit for good behavior. You could make hundreds of on-time BNPL payments and your credit score wouldn't budge an inch. But miss a payment, that's when things change dramatically. A study found that 15% of BNPL users with at least one late payment reported that this negative information was reflected on their credit report. These missed payments can be sent to collections agencies, which absolutely will report to credit bureaus, creating negative marks that stick around for years. The credit bureaus themselves recognize this problem. Equifax, Experian, and TransUnion are actively working on new systems specifically designed to include BNPL loans in credit reports. As of May 2024, the Consumer Financial Protection Bureau has issued an interpretive rule requiring BNPL providers to report these loans, though the implementation details are still being finalized. This creates what I call the BNPL credit paradox. You get all of the risk with none of the reward. While this reporting gap exists, you're essentially in a no-win situation. Do everything right and gain nothing. Make one mistake and potentially lose big. What makes this especially concerning is who typically uses these services. Research shows that 37% of BNPL users have credit scores below 620, significantly higher than the general population. These are precisely the consumers who would benefit most from building positive credit history. Yet, BNPL offers them no path to do so. There's another hidden credit danger that almost no one talks about. When you stack multiple BNPL loans across different platforms, traditional lenders viewing your credit profile might see something that raises serious red flags. A pattern that looks suspiciously like credit cycling. Credit cycling occurs when someone repeatedly maxes out credit, pays it off, then immediately maxes it out again. A behavior that signals financial distress to lenders. Multiple BNPL accounts with overlapping payment schedules can create a similar pattern, even if you're making all payments on time. To a mortgage lender reviewing your application, these recurring short-term loans might suggest you're struggling to manage cash flow. Speaking of mortgages, consider this scenario. You're ready to buy your first home, you've saved for a down payment, and your income qualifies you for the loan. But the underwriter notices numerous BNPL accounts on your credit report once they start being reported. Even if they're all in good standing, these obligations reduce your debt-to-income ratio, potentially decreasing how much you can borrow, or worse, disqualifying you entirely. The CFPB's findings paint an even more troubling picture. Their research shows that BNPL users experience higher rates of financial stress, with BNPL users reporting more missed payments and overdraft fees compared to non-users. This suggests that people using these services may already be financially vulnerable, making the asymmetric credit reporting even more problematic. When we look at the demographic breakdown, the issue becomes even more concerning. BNPL usage is particularly high among younger consumers, with 28% of BNPL purchases made by borrowers aged 18 to 24. These young adults are at a critical stage for building credit history, yet the credit-building opportunity is completely missed with BNPL. The regulatory landscape is evolving, though. The CFPB is actively working to ensure BNPL providers follow consumer protection laws similar to those governing credit cards. This shift could eventually lead to more comprehensive reporting practices that capture both positive and negative payment behaviors. Until then, consumers are caught in an unfair system where only negative information flows to credit bureaus. Think about how absurd this would be in any other context. Imagine if your professor only recorded your failed tests but never your passing grades. Or if your employer documented every mistake but never your accomplishments. That's essentially how BNPL currently operates in the credit reporting world. This one-sided reporting creates a particularly cruel irony for consumers who choose BNPL specifically to avoid credit card debt and protect their credit scores. They've made what seems like a responsible choice, only to discover it offers none of the benefits of traditional credit while still carrying many of the risks. For consumers with established credit, this asymmetric risk might be manageable. But for those with thin credit files or rebuilding after financial setbacks, the stakes are much higher. A single collections report from a missed BNPL payment could significantly set back their credit journey. And let's be clear, these missed payments aren't always the result of irresponsibility. The complex web of payment schedules across multiple BNPL providers makes keeping track exceptionally difficult. Add in automatic withdrawals that might hit on days when your account balance is low, and even the most organized person can slip up. The CFPB report highlighted another troubling pattern. BNPL borrowers tend to have higher balances on other unsecured credit lines, including credit cards. This indicates they may be financially stretched thin, using BNPL as just one piece in a precarious debt juggling act. When your financial situation is already delicate, the last thing you need is a surprise credit score drop. Looking forward, the inclusion of BNPL data in credit reports could eventually be positive if implemented properly. Comprehensive reporting that captures on-time payments could help consumers build credit while using these services. But until that system is fully established, BNPL users are operating in a credit reporting blind spot that disproportionately captures negative information. For anyone considering using BNPL, understanding this credit score risk is crucial. While the no credit impact marketing might be technically accurate for the approval process, it presents an incomplete and potentially misleading picture of how these services interact with your broader financial profile. The fundamental question every consumer should ask is, why would you take on financial obligations that offer no credit building upside, but still carry significant credit damaging downside? It's like playing a game where you can only lose points but never gain them. The deck is stacked against you from the start. The regulatory Wild West, missing consumer protections. Playing a game where the odds are stacked against you is one thing, but what if you suddenly discovered the game had no official rules? That's the reality of the buy now, pay later universe, until very recently. While credit cards have operated under decades of consumer protection laws, BNPL services have been functioning in a regulatory blind spot that left users vulnerable exactly when they needed help most. Think about the last time you used a credit card. Whether you realized it or not, you were protected by a robust framework of federal laws. The Truth in Lending Act, the Fair Credit Billing Act, and other regulations give credit card users specific rights when things go wrong. If your order arrives damaged, if you're charged incorrectly, or if a merchant refuses to honor their return policy, you have legal backing to dispute these issues. But what happens when your $500 laptop purchased through a BNPL service arrives with a cracked screen, but the merchant claims it was your fault? Or when you return an item but keep getting charged anyway? Until recently, you were pretty much on your own. This regulatory gap created real problems for real people. More than 13% of all BNPL transactions involve a return or dispute. That's millions of situations where consumers needed protection but found themselves in uncharted territory instead. Picture ordering furniture through a BNPL service, returning it because it arrived damaged, but continuing to receive payment demands while the merchant and BNPL provider point fingers at each other. Without clear rules governing who's responsible, consumers have been caught in a frustrating game of corporate hot potato. The Consumer Financial Protection Bureau, CFPB, identified this exact problem in their analysis of the BNPL industry. They found that most BNPL providers weren't following the same dispute resolution procedures required by the Truth in Lending Act. When a dispute arose, consumers often couldn't freeze their payments while the issue was being resolved, something credit card users take for granted. Instead, many reported being sent to collections over disputed purchases, damaging their credit despite their best efforts to resolve the situation properly. Another critical protection missing from the BNPL landscape was standardized disclosures. Credit card companies must provide clear, consistent information about interest rates, fees, and terms in a format that allows consumers to easily compare options. BNPL services, by contrast, have been presenting their terms in wildly different formats, often burying important details in lengthy terms of service agreements. This lack of standardization has made it difficult for consumers to understand exactly what they're signing up for, or to make informed comparisons between different BNPL options. The absence of these protections wasn't an oversight. It was a feature of the BNPL business model. By positioning themselves as payment methods rather than credit providers, BNPL companies found a loophole that allowed them to avoid regulations that traditional lenders must follow. This regulatory arbitrage gave them a competitive advantage but left consumers exposed. Some states tried to fill the gap on their own. California, for example, classified BNPL products under their California financing law, requiring providers to obtain licenses and comply with state consumer credit regulations. But this piecemeal approach created a confusing patchwork of rules that varied depending on where you lived, hardly the consistent protection consumers need in an increasingly digital marketplace. Internationally, other countries moved more quickly than the US to close these regulatory gaps. The European Union began addressing BNPL through its Consumer Credit Directive, recognizing that regardless of how these services marketed themselves, they were functionally extending credit and should be regulated accordingly. The good news is that the regulatory landscape is finally changing. On May 22, 2024, the CFPB issued a landmark interpretive rule confirming that BNPL lenders are classified as credit card providers under federal law. This classification means BNPL companies must now provide consumers with key legal protections similar to those that have long applied to conventional credit cards. What does this mean for you? For starters, you'll now have the right to dispute charges and withhold payment while disputes are being resolved. BNPL providers must investigate billing errors when you report them and provide clear explanations of their findings. They must also offer grace periods before reporting late payments and limit your liability for unauthorized charges. This regulatory shift comes after years of mounting consumer complaints. A staggering 28% of BNPL users reported problems like being overcharged or facing impossible return processes. The CFPB's action signals a recognition that while innovation in financial services is valuable, basic consumer protections shouldn't be sacrificed in the name of disruption. But questions remain about how effectively these new protections will be implemented and enforced. Will BNPL companies fully comply with these regulations, or will they find new loopholes? Will consumers know their rights and how to exercise them? And what about other aspects of BNPL that still lack oversight, like the impact of multiple loans on financial stability? The CFPB's rule is a significant step forward, but it's worth noting that it took years of consumer harm before regulators caught up to the rapid growth of BNPL services. This lag time between innovation and regulation highlights a broader challenge in financial services. How do we encourage beneficial innovation while ensuring consumers aren't harmed in the process? For now, if you're using BNPL services, it's important to understand that while you have more protections than before, the implementation of these rules is still evolving. Document everything related to your purchases. Take screenshots of order confirmations, keep all emails and text messages about your purchase, and note the dates and names of anyone you speak with about issues that arise. If you need to return an item, follow the return instructions precisely and get tracking information for your return shipment. If you encounter problems, know that you now have the right to dispute charges with your BNPL provider directly. Put your dispute in writing, email is fine, and be specific about the issue. If the BNPL company doesn't resolve your problem, you can file a complaint with the CFPB through their website. Remember, too, that these new protections only cover certain aspects of BNPL usage. They don't address other risks like overextension from multiple loans or the potential impact on your credit score. The regulatory framework is still evolving, and there may be gaps that leave you vulnerable in ways you don't expect. The transition from regulatory Wild West to properly regulated financial service is underway for BNPL, but it's not complete. While these new protections represent real progress, they're arriving after millions of consumers have already experienced problems. The lesson here isn't just about BNPL specifically, but but about approaching any new financial product with caution. The debt stacking crisis. How multiple BNPL loans create a dangerous cycle. New regulations might protect you from billing disputes, but they can't save you from the mathematical nightmare of debt stacking. Picture this: 5 different payment schedules from 5 different companies, all hitting your bank account at different times. This isn't a hypothetical scenario. It's the financial juggling act sending thousands of BNPL users into a tailspin every day. When you use a single BNPL service, keeping track of your payments seems straightforward. But what happens when you add another, and another, and then 2 more? Suddenly, you're caught in what financial experts call loan stacking, the practice of taking multiple BNPL loans across different providers simultaneously. Here's where things get messy. Each BNPL provider operates in its own silo. Klarna has no idea you have active loans with Afterpay. Affirm can't see your zip balance. Each company only sees their small piece of your financial puzzle, creating a dangerous blind spot in your overall debt picture. The numbers from the Consumer Financial Protection Bureau paint a troubling picture. Not only do roughly 2/3 of BNPL borrowers have multiple loans running at the same time, but 1/3 of users spread those loans across multiple different providers. This fragmentation makes it nearly impossible to get an accurate picture of your total obligations.